Yo, what's up, guys? It's your boy Looney. And if I had to start investing all over again in 2025, I would do things very differently. Some of these lessons cost me money, some of these cost me time. But if you're new to investing, or even if you've been doing this for a while, these are 5 things that would have changed my entire journey. But before we get into this video, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month where you get access to one-on-one coaching, trade callouts. I have an option selling course, I do giveaways, and more. You can check it out. All the links are down below. I do also want to mention Moomoo. They're running a really good offer. I have a referral link. You can check it down below, and you can get up to $1,000 of NVIDIA stock, as well as 8.1% APY on idle cash. There are terms and conditions. They do apply, but again, down below. So let's get into this. Now, number one is I would build a smaller, high convicted portfolio. Because you see, when I first started, and when many first start, they don't know what to buy. So they end up just buying everything. And in my eyes, every stock kind of looked interesting. Every hype name on social media, this might be the next big thing. Every shiny ball was kind of attracting me. And I was under the mindset that everything just goes up over time. And all that did was spread my money thin and actually increase stress and just overall management. Now, if I were starting again in 2025, I would aim for 5 to 8 stocks max and companies that I truly understand, whose businesses models that I believe in long term. And a smaller portfolio keeps you focused and you make better decisions. And your growth actually compounds faster because you're not just juggling 20 ticker symbols. And again, you don't see those gains. When you're buying one share of each stock, you're not seeing those gains. But if you're buying hundreds or more, you can run covered calls and you can do other strategies with it. And you actually realize those gains a little bit more. And again, you'll compound a lot faster doing that. And same thing goes with crypto. I'm still in that issue, and I'm explaining this as one of my issues, and I'm still actually have this ongoing. There are a few stocks that I am looking to get rid of, but I am running covered calls to get rid of these shares, so I'm not as poor management as I was when I first started. Now, number 2 is I would automate. Now, this is something I did do when I first started, but I would definitely do it more aggressive and again on the stocks that I'm convicted on rather than just doing it randomly. Because trying to time the market is actually one of the fastest ways to burn out. You end up buying too early, or you wait too long, or the market dips right after you go all in. And I've done all that, right? Now, if I were to restart, I would do my automatic DCAs and just keep it constant. Not look at it day to day, not look to sell, not look to buy more. Just keep it very boring and consistent. And I'm doing that now. I'm doing it on Bitcoin. I haven't been selling. Now, I've taken profits from Bitcoin, but overall, this is a long-term play. So there's no need for me to overthink it and trying to time these things and just overall buy every day. I'll buy the dips, and if it keeps going down, I'll just continue to buy it. And that automation actually removes emotion. And emotion is actually what ruins most investors. And the truth is, almost every successful investor in history actually won by being consistent and not perfect. Now, number 3 is a little bit more current. And this is something that I learned in my later of investing career, and that is covered calls don't always work. And what happened in this year, I ended up selling covered calls so aggressively. And this one definitely hurt a lot. And it was a good way to learn. It was good learning lessons. Now, when I first started, I sold covered calls on almost everything because the premium looked good. And also I did it at higher deltas, but I didn't fully understand the trade-off because yes, you do get income from these, but you also cap your upside and opportunity costs. And I did that on stocks that I actually wanted to own long term. Now, if I could go back, I would definitely only sell covered calls when the stock is super stretched out or green. And I'm okay with getting the shares called away at whatever strike price I chose. Now, if the strike is far enough out to give me breathing room, this is a perfect setup. Now, covered calls are a great tool and I still do them, but they're not free money. And I'm using them strategically and not just emotionally. And during this time, during the year, I actually was in a difficult situation because, of course, the market ran pretty hot after the April tariffs, and I was running covered calls. And the stocks that I was owning, it was running past the strike prices, and in turn, I had to roll them for a net debit, and there was a lot more management. If I were to go back, I would be a little bit more patient, maybe not sell covered calls on all my shares, and that's exactly what I'm doing now. For example, Mara, Riot, I'm still running these covered calls, but I'm doing them at higher strike prices, higher deltas, and not on all my shares. So again, using them strategically, not emotionally. Now, number 4 is something that I learned this year, kind of during the same time, is I would buy more when fear spikes. Now, some of my best long-term returns came from moments where the market actually felt hopeless. And we saw that on April. A lot of fear, high VIX, red day, terrible news, and just kind of the panic selling mentality. And I bought a lot of SoFi. And SoFi right now for my portfolio is probably one of my best returns. I'm up 158%. And even if the market kind of turns around, I'll be in a really good situation with this stock. Perhaps I'll even buy more. And what I learned was I was being too aggressive. And although you can't time these things, I was not stressing the importance of holding cash and striking when fear is high. And with Riot, for example, I am positive, but I could have been in a lot better situation if I didn't go all in before it dipped, because I was being more aggressive during 2024 when the stock was trading at the 12 or 13, when I could have waited for that more fear or that higher VIX back in April when it was under $10 and then sell cash secured puts or buy shares outright. But when you're new to investing, you kind of get into a moment where you're freezing, right? When there's a lot of fear, you sort of freeze. You don't know what to do, or you're all in cash. So I think also with this point, holding cash is super important. Having that availability for fear is important. So you need to hold cash for those opportunities. And usually these are actually the best entries, is when there's max fear. And when fear is high, this is when I personally am now increasing my buying, whether I'm selling puts, whether I am just buying shares outright, or even buying leap calls. Now, on the other hand, when fear is low, and you can look at that through the VIX and other indicators like the Fear and Greed Index and some other ones, maybe even bonds, but this is a really good tool that I like looking at is the VIX, and you can see it's pretty low. I mean, anything under 15 is considered low, and that's when I like to slow down and hold more cash. So if we do continue this downtrend, I will look to sell some of my shares, maybe let them get called away through my covered calls, because usually they kind of go hand in hand. If the fear kind of subsides, at the same time, the market tends to go up, and my covered calls should get called away, and then I'll turn it into cash. Now, with this, you don't need perfect timing. You just need to buy when the market is mispriced by emotion. Now, number 5, and I still sort of do this, and I'm sure everyone kind of does this, whether they admit it or not, and that is I would stop comparing my portfolio to everyone else. And this one is huge because social media makes you feel like you're behind. Everyone's posting their wins, their perfect entries, their massive returns. You're seeing 1,000 to 100,000 portfolios. But while you're staring at your portfolio, you're thinking you're doing something wrong. But comparison actually sometimes leads to rushing, chasing, over trading, and just over investing and just over allocating. And your risk management becomes very poor. And this is exactly how people lose money. Now, if I were to restart in 2025, I would stay in my own lane. And I am doing that now. I still compare, but I'm doing it in a healthy way. I'm looking to see where there's opportunity and kind of just put my watch list, but I won't actually chase the trades. But with my own, I'll look at my own timeline, my own goals, my own strategy. I'll look at my own cost basis, because a lot of the times when people are offering or promoting a stock, it's because they bought low and it's already high. So they'll promote to you to buy it. Now, for my own self, I won't look to buy it unless it's under my own cost basis. So simple strategies like that, I will look at and just self-evaluate. And your portfolio doesn't need to look like anyone's else to actually be successful. So yeah, those are the 5 things I would do differently if I started investing today. A smaller, more concentrated diversity or concentrated portfolio, automated DCAs, maybe even smarter covered calls / selling options, buying the fear, and focusing on my own journey. If you're new, hopefully this saves you some headaches. If you're experienced, maybe it's a good reminder. Drop a like if you found this video helpful and comment below. What's one investment mistake you would undo if you could restart? I'll catch you in the next one. Peace.